Hi, everybody. Hi, everybody. Thank you for joining us for our last analyst call of the season. Today, we will be talking about liquidity trends. So a lot of you guys, I think, have already tuned in before, but in case you're unfamiliar, Kaiko has a monthly research analyst call, and we'll talk all about liquidity trends, crypto markets, and the biggest events that are happening today. So just in case you are new here, a bit about who we are. Kaiko is a crypto data provider. We have been around since 2014. Today, we offer 6 main crypto data and information services. The first is our market data. This is tick level and aggregated data for more than 100 exchanges. We offer DeFi and blockchain solutions, analytics, and then rates and indices. These are our data products. We also offer research. So that is what you're here today. You're going to listen to all of our research analysts, and we'll talk about the markets. And then finally, visualization. We have some data dashboards for deeper research. So just some tiny Kaiko updates before we get going. We recently launched SIBO Kaiko rates. This is for settlement of futures contracts on SIBO Digital. We also have expanded our DeFi coverage. So that's sort of why we are going to be talking a lot about DeFi today, is that we're really working on our DeFi data offerings to complement our centralized exchange data. Kaiko Research. We have 4 main research products. You guys have probably seen some of the newsletters. We offer 2. One is on Monday, the data debrief, and the other is on Thursday, Kaiko's deep dive. We have a quarterly report, a chart book, and then finally the analyst call, which is once per month, where we'll talk about all of the research over the previous month. And yes, just a bit more about Kaiko's data solutions. Everything that you see here, every chart is made using Kaiko data. If you're interested in Kaiko data, please reach out. We would be happy to get you a demo or a trial of the data. So I think we can get started. Today, we are going to be talking about centralized versus decentralized exchange liquidity insights in 2023. It's really important that we talk about this because we have some big events happening in 2024, namely the possible approval of a Bitcoin ETF. That has a lot of implications on liquidity. So the question we want to answer today is, what does liquidity look like on both centralized exchanges and decentralized exchanges? For DeFi, we typically have not focused too much on this over the past few months. That's mostly because there wasn't that much activity, but we are seeing a reversal in this trend today. So the first is just a basic chart that I'm going to show. This is monthly trade volume actually since 2020. 2020 was when DeFi first became a big phenomenon. So here we have aggregated both centralized and decentralized exchange volume. I think until last month, the trend was quite grim. It showed volume progressively getting lower and lower every single month, but we have had a pretty nice turnaround. In November, volumes actually hit I think 7-month highs, and they've been increasing now for 2 consecutive months. This is due mostly to what has happened in markets. Bitcoin is rallying, all tokens are rallying, and we're really hitting multi-year highs for a lot of token prices, which has impacted volumes. Let's zoom in a bit on DEXs though. So here we're just going to look at DEX monthly trade volume, the same chart, but only DEXs. Kaiko today covers about 8 different decentralized exchanges, which are aggregated here. Just a disclaimer is that we don't cover all DEXs, but most of the liquid ones. So here we see that in 2020, this is when DeFi first gained a bunch of users. It was called DeFi Summer. And all-time highs were hit a few months later in trade volume. And then we saw this steady downward trend that we saw also for centralized exchanges. But the good news is DEX volume is also rising. And we've seen that with the red annotation to the right. However, when you look at the DEX to centralized exchange market share of volume, DEX is in orange. You can see that overall, it's still a lot less than 10% of total transaction volume is for DEXs. And this hasn't really changed that much over the years. There's been pretty much a steady trend in volume across these 2 types of cryptocurrency exchanges. So DEX volume, although we've seen a similar increase, it has not had a big impact on overall market share. So let's now dive in. Who are the main actors in the DeFi industry? On DEXs, so dark blue, we see it is Uniswap. I think by and large, Uniswap is the largest DEX in Kaiko's coverage, one of the largest in the industry. You'll see the V1, V2, and V3. This simply references the version of the decentralized exchange. Every time they upgrade, it is essentially considered a brand new DEX. But we aggregate the data here. Number 2 is Curve. Curve is a DEX that is specializing in stablecoin swaps. But this trend has stayed mostly the same over the years, that both Uniswap and Curve are the dominant exchanges that we see here. Uniswap used to be closely competitive with SushiSwap, but that changed in 2022. SushiSwap today has barely any volume. So this chart is taking a look at both a DEX, the biggest DEX, Uniswap, and Coinbase, which is one of the biggest centralized exchanges. So we compare these 2 exchanges. We've done this comparison frequently over the years just to understand the sentiment around DeFi. We think it's a good overall indicator of that. We can see here that Uniswap's market share today is about 40% relative to Coinbase, which is pretty good. That means that Uniswap still has pretty big volumes, and Coinbase is the 2nd largest exchange in the world. So Uniswap certainly is a very big exchange. Uniswap's volume has climbed past 50% a handful of times over the past few years, and those have been during big surges in DeFi activity. So what are the types of assets that are traded on centralized versus decentralized exchanges? I think it's quite interesting. They vary quite a bit. On centralized exchanges, you tend to see more like top 5 crypto assets. Bitcoin, ETH, XRP, Doge, and Cardano's ADA were the top 5 assets on the selection of centralized exchanges that we looked at. Whereas on DEXs, we see a slightly different trend. First is that stablecoins are by far the most traded asset on DEXs. You have USDC, which essentially denominates almost every single liquidity pool on DEXs, DAI, and USDT. And then you, of course, have ETH, wrapped ETH, and then wrapped BTC. These are just wrapped versions of BTC and ETH. But it's interesting to see that DEXs, they tend to favor stablecoins. Now, the last 2 charts I'm going to show are the average trade size. So during a bull run, on average, the trade size placed by traders tends to increase. And we measure that by dividing the trade volume by the the trade count, which is the quantity of transactions. So here we take the average trade size across all centralized exchanges, and it's climbed quite a bit since September. That's when Bitcoin started to rally and all markets started to rally. So we've seen the trade size has increased from about $160 to nearly $220, which doesn't seem like much, but it is quite significant when looking across thousands and thousands of trading pairs, which is what this data aggregates. On DEXs, we see a similar trend. We can see that the average trade size has increased also, this time since October, from about $1,000 to $3,000. You'll notice that DEX trade sizes tend to be a lot larger than what you would see on a centralized exchange. We are excluding Curve here just because Curve has average trade sizes of nearly $60,000, so it tends to skew the graph. So that is our volume analysis, looking at average trade size, volume, and market share on the two types of platforms. Let's now move on to liquidity trends.
Yes, so we can start with the first chart. So last time we talked about the Alameda gap. For those who are new to the webinar, it's the gap in liquidity left by the collapse of FTX. It has been pretty sticky. Market depth has not moved a lot, even though prices are up and volumes, as Clara mentioned, are also up. So this is the 1% market depth for crypto liquidity this year. It has increased, it has recovered, but barely to its levels from early August, before the August 17 sell-off. And it's mostly a price effect because most altcoins are between 10 and 200% since the start of October. In native units, market depth is still down for Bitcoin and Ethereum, and for altcoins it is pretty mixed. So the next chart actually breaks this down by asset, and it shows market depth over a slightly longer period of time. So since October of last year, we see that it's still below its pre-FTX levels. And for Ethereum, it has been pretty flat. Actually, Ethereum has seen almost no increase in market depth this year. For altcoins, interestingly, market depth is increasing, and it's almost equal to Bitcoin market depth since July. It has been rising at a faster pace. And if we look at the next chart, which shows the market share of market depth for 2023 and 2022, it actually shows that the share of Bitcoin in overall crypto liquidity has been declining. So last year it was around 50%, and this year it's around 37%. In contrast, it has increased for altcoins. So what are the altcoins driving the increase in liquidity? And this is the next chart, which actually shows altcoins liquidity. So this is the 1% market depth, the bids and the asks within 1% of the mid price. For the different groups of altcoins by market cap, we have the top 10, the 10 to 20, and 20 to 30. And we essentially see that the increase in altcoin market depth has been driven by the large caps, so the top 10. Next, where is this liquidity being concentrated? And so this chart here shows the 1% market depth for US and offshore exchanges, and I have broken this down for Bitcoin and altcoin, essentially because for Bitcoin, we have a gap between offshore and US exchanges that is going down. And for altcoins, it is pretty significant. Almost 70% of altcoin liquidity is currently offshore. For Bitcoin, it's around 60%. Interesting thing also for altcoins, the recent increase in liquidity has been driven by both US and offshore exchanges. So just one caveat here, the declining gap between US and offshore exchanges, it's mainly due for Bitcoin, is mainly because Binance market share has declined this year pretty significantly. We know that they had some regulatory issues. They also removed zero fees. So this has actually led to a smaller gap between US and offshore exchanges. However, the next chart shows the average daily Bitcoin liquidity for the top US platforms versus Binance, and we see that Binance is still by far the most liquid Bitcoin market. We have essentially 3 liquid US platforms with Kraken, Coinbase, and Bitstamp having a daily liquidity of more than 10 million, and it is well below Binance. Binance has around 46 million daily. And so the next chart actually shows the same data, but aggregated for all centralized exchanges for by asset. And here, the interesting thing is that the gap between Bitcoin and altcoins is pretty huge. This is, of course, related to the fact that Bitcoin has a first mover advantage. It essentially has 10 times more liquidity than the top most liquid altcoin, which is XRP. And interestingly, this gap has been declining, but very slowly. So it's quite interesting to see how things will change with ETFs. We know that typically ETFs have a net positive impact on the liquidity of the underlying asset. So next, I'll leave the floor to Riyad, who's going to talk about on-chain metrics.
Thanks, Desi. Yeah, if you pay any attention to like crypto Twitter or anything, it really seems like right now Solana is the center of attention, following that some big airdrops on the network. While Ethereum, it's had a little bit of disappointing price action, but as we've seen, DEX trades have ticked up. So I'm reminded a bit of the Yogi Bear quote. It's too crowded. Nobody goes there anymore. Essentially, we've seen the gas fees tick up to the point that now it's, it can cost over $30 just to do a basic swap on Uniswap. So it seems like to some extent this has crowded out some of the smaller retail users, but whale activity on the network, I would say, is at highs this year. And we can see an example of that on the next slide with this arbitrager wallet. They were dormant for most of the year. You can see there was a little bit of activity in September, and then starting in November, it was off to the races, doing about $1 billion worth of transactions on Ethereum each day, and this included outflows to centralized exchanges and stable coins, as well as some DEXs. You can see some 1-inch trades, some deposits on Compound and Aave. So even though Ethereum has taken the backseat, it does seem to still sort of be a nexus for this whale activity and more sophisticated actors who don't mind slightly higher transaction fees because they get pretty good liquidity across Ethereum DEXs, as we've seen. And on the next slide, we have another just sort of example of the increasing activity on Ethereum. You can see that variable borrow rates for USDC and USDT have continually risen since the start of September. This generally means that people are depositing ETH as collateral and borrowing a stablecoin, so it allows them to stay long ETH while getting a stablecoin that they can use to trade for other tokens or do something else like that. So when we see that tick up, it is a sign that there's more of a sort of risk on sentiment. For BTC and ETH, we can see that they're basically flat. This is sort of just a function of how these protocols work. They're pretty popular as collateral, not that popular to borrow, but still interesting nonetheless. And then we have one more slide. This is a topic I've talked a lot about, staked ETH liquidity. We've also seen this essentially flatten out since about September. The curve pools haven't shrunk too much more. The one caveat here is that the recently released Blast L2, which is sort of in its like airdrop farming stage where users can send tokens, mostly staked ETH, to farm the airdrop whenever the L2 is released sometime next year. So that has led to a slight outflow in these curve pools, though not as much as I would expect. So again, just always keeping an eye on this, because I do think that this is sort of an underrated, important part of the Ethereum ecosystem. If there's not enough liquidity in here, that can lead to deviations and discounts where staked ETH doesn't trade equal to ETH, and that could cause big liquidation events because a lot of staked ETH is deposited in these lending and borrowing protocols and then looped for better yield. So yeah, we'll be happy to answer any questions about that.
Cool. Thank you. Okay, so we have a few questions. Maybe we can start with the DeFi stuff first. So let's start with Nathan's. How do you define an arbitrager wallet?
Yeah, so this a wallet that was actually tagged, I believe, on Arkham, tagged to an asset manager that, after doing some research, I saw offers a stablecoin arbitrage product, and after analyzing some of the transactions in depth, that really seemed like the only thing it could have been.
Cool. And also, I guess, trade size on DEX is significantly larger. So it's always been the case, which is quite interesting. Average trade sizes on Uniswap over the years have hovered at a few $1,000s, which is way higher than what you would see on pretty much any centralized exchange. It's probably because of gas fees. That's probably one reason, is that it's just more expensive. When there were periods of extremely high gas fees, it just made more economic sense to have larger trades. But also probably that there's more whales on DEXs too than what you would see on centralized exchanges. DeFi tends to be more niche, and it's more complicated to have effective trading strategies. So it tends to favor more savvy traders. But maybe, Riyadh, you have a different perspective.
Yeah, I agree. I think you can largely chalk it up to gas fees, and the fact that centralized exchanges make it easy to break orders apart to get better execution. So I think that explains most of it. And yeah, as Claire mentioned, there are, I think, a higher proportion of whales in DeFi in general. So yeah.
And what are the advantages of using DEX? What does it mean that the market has not really adopted them as the level remains stable? I mean, that's a great question. I think a lot of people predicted DEX usage to increase a lot after the FTX collapse, because it sort of proved that centralized exchanges could not be trusted. We didn't actually see that, though. DEX volume stayed mostly flat relative to centralized exchanges, even after the FTX collapse. Maybe, Riyadh, do you have more input?
Yeah, I think the main advantage of DEXs is that they are non-KYC, and it's, anybody can list a token. I mean, those can also be drawbacks, of course. But I do think that those are really its main advantages at this point. And transparency as well, I think, is a good one too. I see a question about correlation of gas fees and token price. I haven't seen any correlation besides volatility. So if there's a big market event, a big sell-off or rally, we will see token prices increase, or gas fees increase.
Are DeFi generally where trades originate first before moving to a centralized exchange from a price discovery point of view? So that's a great question about price discovery. I would say most tokens, the price discovery happens on centralized exchanges. The reason is because a lot of these DeFi protocols use oracles, And Oracle price feeds are pulled almost always directly from centralized exchanges. And there's just more people. It's easier and quicker to sort of get a consistent consensus price on a centralized exchange. Whereas in DeFi, it's still more niche. So I would say price discovery still happens almost always on centralized exchanges and then trickles down to DeFi, unless there's the altcoin only trades on a DEX, of which you have many. There's many meme coins that only trade on Uniswap, in which case price discovery only happens there.
Yeah. Are whales mainly individuals, or does that also capture institutions? It's hard to say. I think from other analyses I've seen, there are a lot of just individual whales who bought into Ethereum really early and now have just a ton of ETH. I think that's also sometimes reflected when you see, like, you know, I guess you could say like status symbol NFTs trading for hundreds of ETH or things like that. But there are certainly institutions, and you can generally tell, like in the chart that I showed, when they're doing that consistent amount of transaction volume over that many days, tends to be an institution. Although there are certainly, like MEV bots designed by individuals that also do huge volume. So it's hard to put an exact figure on it, but I think there's a good amount of both.
Okay. So here we're talking about liquidity. Let me try and find the chart. US versus offshore, that the gap is widening. Maybe Desi, feel free to just talk. Yeah.
So yes, it is widening slightly in November because the increase in Bitcoin market depth has been driven by offshore. But compared to November of last year, it is definitely smaller for Bitcoin. For altcoins, I mean, 70% of altcoins liquidity is offshore, so I think it's quite significant.
Yeah, it is interesting to see the big gap for altcoins, that it does seem to get wider on offshore exchanges when looking at liquidity. Any other questions? So what is included under offshore? So we have, like, I think more than 25, or is it all exchanges?
This is asset metric, so.
Yeah, so it's actually all exchanges in Kaiko's coverage. The altcoins is like the top 25 or 30. Yeah.
Yeah, something like that.
Yeah, so this is using one of our most powerful data products. It essentially aggregates market depth across all exchanges in Kaiko's coverage. We have like more than 100 exchanges. Some have gone out of business. So I think in total active exchanges, it's a bit more than 50. And it's the sum of the order book depth.
So are we talking about Bitcoin or altcoins? Wait. Okay, so comparing from last year to this year, although looking at 3 months, so if we are talking about altcoins, yes, the gap has definitely widened. For Bitcoin, it has actually declined year over year.
Okay, any more questions? Okay, so this is asking, will the market share of DEXs, is it going to change? That's a good question. I would say it's pretty tough for DEXs right now, just because regulators are really focusing on all transactions. Even though they are decentralized, regulators still are sort of cracking down on DEXs. So I think it's going to be tough over the next year for DEXs to maintain their sort of openness that they once had. In which case, the market share will probably stay similar, if not fall. But one caveat to that is we're sort of seeing a bull rally happen, and during a bull market, often DeFi activity spikes, which could actually cause a big increase in DEX volume, specifically because a lot of new tokens trade on DEXs when they first list, and a more retail type of trader typically prefers using a DEX for this type of activity. Any analytics on perps volume on and off chain? So we have a lot of perpetual futures trade volume on centralized exchanges. Right now, we don't cover any DEXs that list perpetual futures or offer that. But similar trends, volumes are also increasing for derivatives. Open interest too is also on the rise. Okay, any more questions? Otherwise, you can register for our next webinar already, which will be the end of January. So it's a bit of a ways off, but I just sent the link. And otherwise, you can subscribe to our research at research.kaiko.com. Thank you all for joining today.
Thank you.